Hi, and welcome to today's Real Estate Minute. I'm Thomas Cook, and special guest today is George Christopoulos from TD Canada Trust. And today we're going to be talking about the credit bureau. Everybody loves the credit bureau. And of course, we all love to know what our scores are. We'd love to have the greatest scores, the highest scores, the best scores. There's two major credit bureaus in the GTA area here that we deal with. Number one is Equifax, and the second one is TransUnion. And most lenders use one or the other. George, which one does TD typically use?
TD prefers to use Equifax, but in some cases where we see some anomalies in the credit bureau, we will ask for a TransUnion credit report also.
Okay. And by the way, if someone's moving in from the United States, can you access their credit there?
Yes, we will and have access to U.S. credit bureaus. We simply need the client's previous address and social security number, and that's easily done. Unfortunately, though, we will not do credit bureaus from overseas, so the U.S. is the only other country that we will do credit checks with. Okay,
so maybe explain what the ratings are, the R1 versus R9, and the Beacon scores. That's sort of a confusing number for people. So
okay, well, let's establish what an R1 is. First off, to understand this, what you need to know is that every month, a report goes out from all the companies that you do business with, Visa, MasterCard, student loans, car leases. They report to these two credit agencies. And they send out a report that states, how much was your payment? When was the payment made? What is the remaining balance on your debt? And this establishes a rating for you. So if your payment was made typically within the 30-day period that payments are due, your rating is what we call R1. R2 would be 31 to 60 days, R3, 61 to 90, and so on and so forth. If all of your credit cards or debts have been paid within the R1 period, you should have no problem being approved for a mortgage. R2 is acceptable too. Even an R3 thrown into the mix will be something that definitely we could work with. But if your credit ratings are R4, R5, or R6, then we've got some issues and definitely may need some more work to do some credit repair for you. Now, all this information gets rolled in and creates what we call a credit score. In Canada, a credit score is called a Beacon score. In the United States, you may have heard the term FICO score. And this is an overall credit rating, and it helps us determine what type of programs you would be approved for as a mortgage. To be approved for a mortgage at a bank, you would need a minimum credit score of approximately 600 points. For some of the specialty programs that we now offer, such as zero down payment, or many of the new programs that we offer for self-employed people that do not show a lot of income, your credit score must be 680 and higher. And it's very important that your credit score is maintained in this manner. What affects it are good repayment habits and not carrying a lot of debt. And the feature we're looking for here is approximately 80% of the limit of the credit card. And if you are constantly keeping your credit balances at 80% or greater, that may affect your credit score. So it's important that you run a credit check to see that everything is in place.
So, for example, there's some very important things that you don't want to do during the last 6 to 12 months of your before you actually buy. Number one is make sure you're making all of your credit card payments on time. Let's say the credit card statement comes in and it says the minimum payment is $50, but you want to pay $250, but you don't have that for 2 weeks after your credit statement date is due. Make that minimum payment. Make the minimum payment of $50 or whatever it is on time, and then 2 weeks later, when you have the extra cash, make a second payment. So that will ensure that you get that R1 rating that you really want. Another thing, of course, is you don't want to be adding new debt on between the time you buy a house and the time you close.
Correct.
Right?
Very good points, Tom, because the whole credit rating system is based on how can you carry the debt that you currently have. So it's very important that you make that minimum payment as opposed to paying off the complete bill 3 months late and having a zero balance at that time. So it's just a determination of can you carry the balances and the monthly payments that are due. Very important stuff.
Yeah, and especially if some people, like you're planning to buy a new vehicle, buy that new vehicle after you've closed on the property. Don't put that extra debt in between the time you buy and the time, or even time you get full mortgage pre-approval and the time you actually close on the property, because that will change the GDS, TDS calculation that the banks use to work out what amount of mortgage that you'll qualify for. So thank you very much for tuning in to today's Real Estate Minute. And I'm Thomas Cook with special guest George Christopoulos, and we'll be talking to you again.